Most people who have built real wealth assume that the hard part is behind them. And in many ways, they are right. The discipline, the consistency, the decisions that compounded over 20 years plus, those are behind them. But there's a different kind of difficult that most of them have never faced. Not building the wealth, making sure the structure underneath the wealth actually holds. This video is about two people who had both problems and only knew about one of them. My name is André Small, a certified financial planner, and I work exclusively as an advice-only planner. That means I do not manage portfolios, I do not earn commissions, and I am not paid to move money. Where I do add value to my client's situation is looking at their full financial picture all at once and find what everyone else missed. Most of my clients come to me after years of doing the right things. The savings, the investments, the contributions, the building of their version of wealth. What very few of them have done is pressure test their structure underneath what they have built. And in my experience, that is almost always where the real gaps live. Let me tell you about Wesley and Amy. Wesley and Amy have a combined net worth of $7.5 million. They're in their early 50s. Wesley sold his business. Amy is a practicing physician with FICO wages over $350,000. Combined net worth of $7.5 million. Primary home, lake house, out-of-state rental, 2 adult children. Oldest is 24, married 2 years. The youngest is 19 and in college. From every visible angle, they are set. They had an advisor managing their investment portfolio, an accountant handling their taxes, and an attorney who drafted their estate documents several years ago. 3 professionals, 3 separate conversations. No one is talking to each other. Handled and coordinated are not the same thing. Wesley and Amy had handled everything, but nothing was coordinated. When I looked at their full picture, I found 4 legs. None of them showed up on the performance report. None of them were visible from the outside. All of them were real. Their umbrella policy was $2 million. Their net worth was $7.5 million. The policy was set when the balance sheet was smaller. With the business sale, the net worth grew. The coverage never followed. Yes, Wesley and Amy are okay with self-insuring, but not up to and more than $5.5 million. If a lawsuit targets visible wealth, and Wesley and Amy have very visible wealth, a $2 million umbrella against a $7.5 million net worth is not protection. That is a partial shield with a $5.5 million gap. The estate plan was 7 years old, written before the business sale, before the oldest child married, before the out-of-state rental existed. Here's what most people do not know. Beneficiary designation on retirement accounts and insurance policies overrides whatever the trust says. If those designations were not updated after the business sale changed the asset composition, the trust is not doing what Wesley and Amy believed the trust was doing originally. 3 properties, primary home, lake house, out-of-state rental, all 3 titled in their personal name. That means every one of those properties sits inside the same legal exposure as their personal balance sheet. A lawsuit against Wesley personally reaches all 3. A claim against one property can reach the others. The entire structure is connected when the goal should be planned and protected for now and later. Amy is a sole active income earner in the household. Physician level income. Wesley's business sale proceeds have been sitting largely in cash since the sale because most of the advice he received from business associates and friends was to wait. The cash is undeployed and quietly losing ground to inflation. The 2 problems inside of one gap. If Amy cannot work, the income structure of the household has no backup. And the liquidity from Wesley's sale, the event that's supposed to transform their financial position, is doing almost nothing. All 4 risk flags, 4 gaps, $7.5 million net worth, a portfolio performing exactly as designed, and a structure underneath that portfolio that had never been looked at. All at once by someone whose job was to find what was missing. Now here's how I work with my clients. I'm not replacing an attorney. I'm not replacing their accountant. I'm not replacing their investment advisor. Or if you like to manage your investments yourself. What I am doing is sitting at the center of all 3 conversations and making sure the decisions made in one lane do not create unintended consequences in the others. Wesley and Amy did not have a wealth problem. They had a coordination problem. The gaps I found were not the result of bad decisions. They were the results of good decisions made in isolation by professionals who were each doing their job without a clear view of what the others were doing. A team of professionals who are not talking to each other is not a team. That is a collection of separate conversations, and the gaps live in between them. That is the gap I failed. Here's what Wesley and Amy built after the full picture was on the table. Umbrella. Coverage aligned to the net worth. The umbrella coverage was restructured, not doubled blindly. Sized intentionally to offset what they were not comfortable self-insuring. Accounting for the properties, the business sales proceeds, and Amy's income profile as a physician. A physician with visible assets in a visible household is a specific liable profile. The coverage now reflects that profile. The estate documents were reviewed, not rewritten from scratch, but pressure tested against the current reality. Every beneficiary designation was pulled and compared against the trust intent. 2 designations were misaligned. Both were corrected. The attorney updated the documents to reflect the business sale, the oldest child's marriage, and the addition of the out-of-state rental. The trust now does what Wesley and Amy intended for the trust to do 7 years ago, but updated for where their life is now. Then, separation built into the structure. The out-of-state rental was moved into an LLC. The primary home was structured differently. Primary residents carry their own legal considerations, but the exposure of the rental and the lake house to the personal balance sheet was reduced. 3 properties. Now with intentional separation between personal assets and property liability, the structure underneath the property matches the intent. Both gaps addressed a disability income structure. A disability income structure was put around Amy's earning capacity, not a generic policy, but one size to the household's actual income need, and calibrated to the business sales proceeds that Wesley already has in reserve. And Wesley's undeployed cash, about $4 million that had been sitting, was given a deployment strategy, not all at once, but intentionally, with a timeline, a tax location plan, and a sequence designed around the household's full picture rather than the portfolio in isolation. The same net worth, the same portfolio, the same professionals, attorney, accountant, and advisor, all stood in place. One difference, a coordinator sitting at the table of every conversation, making sure that the decisions made in one lane serve the goals made in every other lane. That is what wealth by design looks like. Not default, not assumed, but intentional. Wesley and Amy are not unique. The gaps I found in their financial picture, I find versions of those same gaps in almost every comprehensive review I do with households at this level. Not because those households made bad decisions, because the financial system is built in lanes, and wealth that crosses multiple lanes, income, assets, estate, protection, taxes, requires someone that can see across all of them at once. If you watch this video and recognize yourself in one of those 4 gaps, the coverage, the documents, the titling, or the coordination, that recognition is worth paying attention to. Most affluent households have the same 4 gaps, and no one on their advisory team has ever put them in the same room to talk about it together. I built an audit for this very reason. 10 questions, 4 gaps, 3 minutes. The link is below. Find out where your structure stands. I'm Andre. Wesley and Amy spent years building something real. What changed? The thing that actually moved the needle. It was not a different investment strategy. It was a clear view of the full picture, all at once, with someone in the room whose job was to find what was missing and fill the gaps in their financial picture. The self-audit tool is the first step towards the same clarity for your structure, your household, and your financial picture. I'm Andre, strategy first, estate plan next, and freedom always.